it's really important to put this into perspective. We saw a lot of seasonality. We saw that Canadian and US market fluctuating as the seasons went by. So it reminded us of a movie from 1980 called Being There. And in this movie, Peter Sellers plays a simple-minded gardener. And as he's talking about what he enjoys and what he's doing, many people think he's talking about the economy. And then specifically, he says, growth has a season. There are spring and summer, but there's also winter and fall. And then spring and summer again. And as long as the roots are not severed, all is well and all will be well. So given the seasonality that we saw last year, we thought, let's put this in the context of investing. So you have summer. Summer is a time of growth. It's a time of expansion, possible rate hikes. You want to take on a lot of risk here. But summer turns to fall, and you have a bit of slowing growth. Maybe there's some high inflation. We want to take some risk off the markets because we know that something comes after fall. All too well in Canada, we know what winter is like. It's cold. We want to make sure there's a recession. If a recession is coming, we take on a rate cut, maybe minimize risk. But the nice thing is, again, here we are in Toronto. It might not feel like it, but we turn to spring. And there's a bit of a recovery, low inflation, and we start to move forward in the cycle again. So where are we today in this example of seasonality? We think at Nicola that we're at fall. Where there's slowing growth, we have to be mindful of the risks, and we have to think about winter. And we feel that winter is on the horizon. When is it coming? How bad a winter will it be? So it's always useful in the weather analogy as a gardener to look back on seasonal patterns. We can do the same for investments. So when we look at investments, we've charted here the S&P 500 historical bull markets. And you can see that today we're at the longest bull market of the S&P 500 in its history. Over 10 years after in March. So since then, we are the longest one. And so the concern a lot of people might have is this market done? You can see these very different magazine articles. Bloomberg's got a very long bull. The end is near. The next recession. And Barron's best before 2020 date. A lot of concern here. People concerned that this bull market has run its course. We would like to point out a couple of things. First, that the average return over this bull market has actually been pretty low compared to other bull markets. And secondly, we want to keep in mind what Sir John Templeton said, which is the bull markets are born on pessimism, they grow on skepticism, mature on optimism, and they die on euphoria. And if you look at these 4 article covers here, it doesn't look like there's euphoria going on here. So we would say that we're probably somewhere on the skepticism or optimism stage right now. So just like a gardener might have different tools, a barometer, a thermometer, wind speed, things like that they would gauge the weather that's coming, we too in investments also have those tools to us. Let's look at consumer sentiment. So this is the US Consumer Sentiment Index. The gray shaded boxes are periods of recession. This is since about 1980. And consumer sentiment is important. Why? Because it tells us how the US consumer feels. Do they feel good? They're going to go out and spend. They're going to go out and buy things. And what we can see from this chart is that typically there's a lag after consumer sentiment peaks, and then we hit into a recession. And on average, that's 13 months. And you can see on the far right of this screen, looks like consumer sentiment has peaked out. So we're currently at about 3 points. We're currently below the 13-month average, but it has peaked, and it's given us a pause for concern. Something else that we want to look at is pressure, barometric pressure, or in the case of investments, we want to look at wage growth. The key here to remember, again, the gray shaded boxes are our recessionary times, is 4%. When wage growth gets above 4%, it puts inflationary pressures, and it concerns people. It starts to eat into corporate earnings. So you can see that on average, there's a 29-month gap between that 4% to when we enter into a recession. And today, we're about 3.6. That's where the wage pressures are right now. So again, we're not seeing anything imminent in terms of a recession right now. And the last thing we might want to look at is the speed of the economy. Or in gardener terms, you might want to look at the wind speed and what's coming. And for this, we'll look at credit spreads, the ease of access to money that corporations might have. Again, our gray boxes represent the times when we've entered periods of recession, the last 2 times. And you can see when it starts to bottom out and then peak up, we enter into periods of recession again after a lag. The thing to note on this one is that we've been pretty steady. We haven't really peaked out. We did have a small spike when we had our December equity sell-off. We had a small spike, but nonetheless, we still feel, again, this is not indicating an issue. Companies still have access to capital. So we've looked at this. It's also important to look at history. What can history tell us? And so this is the S&P 500 and what's called the forward PE multiple, or price to earnings. In other words, how cheap or expensive is the stock market, the S&P 500? So in 2018, we saw a 4.5-point decline from 20 down to 15.5. How did that happen? Well, we showed you earlier that the S&P 500 did fall, in fact, by 4.4%, but earnings continued to perform, and perform rather well at 24% against a very strong GDP background of 3.1%. So when you look at that scenario, you think, okay, that should have been a pretty good year for investing in the markets. Again, let's use history as a good indication. Let's go back to 1984. In 1984, we had a trade-bound S&P 500. It did about 6%. Again, GDP was extremely strong. Earnings were great. Price to earnings compression of 2 points. Following year, S&P 500 was up 33%. Fast forward to 10 years, 1994. John's playing in a band somewhere. And we've got a scenario where the S&P 500 is pretty flat, 0.3%. Not much going on there, but GDP, again, strong. Earnings, again, strong. And finally, the price to earnings compression multiple comes down by 3 points. And the S&P 500 up 37%. So based on these historical weather patterns, if you will, 2019 should also be a pretty good year, and we certainly saw that with the beginning of the year.